Money, Power, and Monetary Regimes by Pavlina Tcherneva on the myth of barter. In contrast to the historical account above, economists embrace the pervasive but historically unsubstantiated myth of barter. Footnote 5. In the conventional view in economics, money emerges from barter as a means to solve the double coincidence of wants. Economists present these origins as a purely hypothetical, even fictional, example of a barter system. Menger, 1892, recognized the lack of historical evidence supporting the medalist view, and therefore posed a different question. Even if money did not originate from barter, could it have? He thus aimed to perfect the conventional view of money by offering a mathematical solution to the hypothetical scenario of barter. Indeed, the definitive work from Cambridge, anthropologist Caroline Humphrey, 1985, is steadfast in its conclusion. No example of a barter economy, pure and simple, has ever been described, let alone the emergence from it of money. All available ethnography suggests that there never has been such a thing. Barter arrangements, of course, did exist, but there were never a coordinating mechanism for social provisioning in any society. Graeber, 2011, suggests that barter itself is most likely a modern and temporary phenomenon, observed among people familiar with the use of money, but who, for one reason or another, experience a breakdown in those monetary arrangements. Debunking the myth of barter is key, as it debunks the notion that money emerges from voluntary market transactions where agents engage in mutually beneficial exchange, where no single agent has any power over the other, and where the state introduces sizable market imperfections and inefficiencies. Because money is a social power relationship, the socially embedded story of money tells us that it emerges as a public good. Within the complexity of historical, specific social debt obligations, whereby an authority serves as the arbiter of private and public debts, the agency which determines the unit of account, how all debts will be measured, and the enforcer of those debt settlements. That authority is the institution that imposes non-reciprocal obligations on the population and that assumes a redistributive role. In some cases, in the interest of fairness and justice, while in other cases in the interest of colonization and slavery, more below. Placing power, authority, or some social agency that administers and enforces monetary debt arrangements at the center of the history of money also helps to understand modern monetary systems and the powers and responsibilities of nation-states to fulfill their redistributive functions. The importance of the historical record is 1. To delineate the nature of money as a social debt relationship. 2. To stress the role of public institutions in establishing a standard unit of account by codifying accounting schemes, price lists, and private and public debts. 3. To show that in all cases money was a pre-market phenomenon representing initially an abstract unit of account and means of payment during a complex process of social provisioning, and only later a generalized medium of exchange. And 4. To underscore its inherent quality as a vehicle of redistribution. The next task is to use this historical understanding to illuminate modern monetary regimes and the policy space available for pursuing economic goals.